Good afternoon, everyone. My name is Russ, and I welcome you all to our Friday update here on Data Dash. That has been quite an important week in the macro world. CPI, PPI, unemployment data, and they all came in a way misaligned. So I'd like to take your attention and dive into the charts and see what actually has happened this week. We're going to go through some of my favorite setups. We'll cover, of course, the crypto world, but also I'd like to show you how I am making my analysis for the week ahead. We're going to cover some carry trade and foreign currencies. We're going to cover the dollar strength index and much more. With all that said, let's go. For those who missed my short updates on Wednesday, I would love to recap that the CPI on Wednesday has been the miss. And if you see those column of actuals, you would see that we actually had already 6 out of last 8 reports that the forecast has been missed. And it doesn't look, guys, also because the forecasted CPI was pretty much the highest Fed would forecast since October 2023. And even this 3.4 forecast has not been met. That means that inflation is sticky and Fed is in a way not in control, but they're still talking about the cuts and how many cuts we're going to have this year and when they're going to come. So these itself, as I mentioned for the last several Fridays, itself is quite bullish. The thing is also on Thursday, the PPI came in line with the forecast, and month over month, PPI progression has actually been below what Fed was forecasting. Why is it important? Because people very often paying attention to PPI as the producer price index, which actually showcases the inflation from the business standpoint as our guidance of where the CPI direction would go. So here on the chart, for example, you see the black line of PPI is preceding the CPI move, which is shown here in the gray rectangle bars. So for example, what we had in 2020, we had this huge spike in the producer price index, and only then we had the inflation following. So many macroeconomists are treating PPI as a leading indicator, which is actually been followed by the CPI prints. So the fact that we are still having quite a high CPI while PPI is dropping can bring us still in the Goldilocks scenario, which I have been showcasing last few Fridays. On top of that, if we are looking here on unemployment claims, the unemployment claims came actually below the forecast, and the last Friday job data also came very positive. Well, sounds like an amazing place to get long and build up the positions into the election. But I am getting way more cautious with every week passing by. And the reason for that is actually the Fed watch tool. If we're going to look here in the month of July, then we can see that just a month ago, 12.9% of the participants believed that the current rate cuts would stay as they are. Right now, it is majority, the half at least of the market. And we're going to look at September. The majority of participants in September believed that there going to be at least 2 cuts by then. And right now, we are only seeing the opportunity for 1 cut, which is priced in. So that means for all the risk on assets, that's going to be a severe stress. All the smaller companies, all the companies with less profitability and with a higher cost of capital, gonna be in trouble. That, of course, puts pressure on the indexes like Russell 2000 and, of course, on all the smaller stocks. Moreover, I am getting quite concerned about the very bullish chart for 2-year government bond yields. Why so? Because with inflation going higher, Fed is forced to sell the bonds in order to bring the bonds price down. So they are becoming more attractive for the risk-off investors. And what those investors are doing, they are reallocating their money from the stocks, about which they're not sure if there is, the certain controversies like that around inflation, then investors would prefer to have almost 5% guarantee rate for the next 2 years. And as you remember, Nick has mentioned on Wednesday that we are very far from an inverting between 2 year and 10 year. So 2 year bonds are actually giving the high return per year. That is like a very unprecedented scenario that also signifies that something in economy can easily crash. And what happens when those investors are buying bonds, they're selling stocks because they don't have an infinite amount of money. They are relocating them from one basket into another, and that also can drive the stock market to go down. So that's quite a tricky situation here, and you see why. So even with what might be considered as bad CPI prints, the market's reaction to them is relatively moderate. We're only down on Wednesday around 1%. And the thing is, if you're looking at the charts, we see that we are holding on S&P 500 this level of 512 relatively well. And until the market structure is broken, I would definitely not short the market. What I recommend everyone to do is you go to this level 512 and you put an alert on the chart. So that's very important for me. What I am personally doing here, I am hedging my positions with the calls. So I am selling the calls against the assets I own, but I do not yet go short. I would only go short across the markets while this level of 512 is lost, not before. So are we fine for the next couple of weeks? Yes, most probably. Market favors the Fed's stance on the cutting rates, even in the face of potentially rising inflation. So, however, it is becoming also more and more difficult for the Federal Reserve to envision any other ways of managing inflation without resorting to rate hikes. And I know that's an election year. I know that's something we are not anticipating until November, but it is very likely that a Fed would come to the dialogue around rate hikes afterwards, causing the huge spookiness across the market, or B, something in the market would break, probably coming from inverted yield curve for such a long time, and then Fed would need to step in until November, until the presidential elections, and save the market with those cuts that in that case would come as the form of emergency. Well, moreover, we have President Biden's recent remarks, which are actually acknowledging the need to live with inflation. And this could be interpreted as an attempt to discourage the Fed from even thinking about the hikes, kinda safeguarding his re-election bid. So once again, as I've been saying for the last few weeks, these can leave us in a delicate balance between, on the one hand side, strong economy, lower number of unemployment claims, good wage data that does not bring yet wage price spiral, then good PPI and potentially declining CPI. And that is referred as a Goldilocks scenario. So this is something still not out of equations. On top of that, the strong move in DXY yesterday actually is getting retraced. You can see this candle, potential reversal here. Why I think so? Because Euro USD, if we're gonna look at the daily chart, we would see that we are holding the support here and we have swept the previous low and have the potential to bounce. Well, you would ask me, why on earth I'm looking at a Forex chart here? Well, because Bitcoin tends to negatively correlate with DXY, or in other words, the dollar strength index. And the main currency that actually contributes to the dollar strength index is euro. It's almost 58% of the weight in the basket, alongside with Japanese yen, British pound, Canadian dollar, Swedish krona, and a little bit of the Swiss franc. So if euro tends to bounce on those levels and give us around 2-4% breather, that is very, very, very likely that this DCY chart is gonna go all the way down to the level 102, 103. And once we are able to break the market structure here and start accepting below this low, I would not be shy away for seeing DXY in 2 digits, all the way to 98, guys, and that can actually give a very intensified and prolonged rally for the risk on assets. The second main contributor, as some people ask me in the comments to show how I would analyze my day, I would consider the Australian dollar against the Japanese yen as quite an important indicator for risk across the market. So Australian dollar during the carry trade is normally used by the investors to actually buy the risk on assets, and the Japanese yen is normally used to buy the risk of assets. So if Australian dollar is more demanded than the Japanese yen, that means that investors are still valuing the risk. However, on the weekly, we can see that we are getting slightly overextended and we start building multiple divergences one after another. So it could actually mean, in my opinion, that this is like a topping formation and we're going to retrace back into this high volume candle around the area of 98. So that can, in my opinion, totally signify the potentiality for a certain retrace, maybe below our favorite level of 512, where we have set our alert, but let's see and let's be open to any possibility in the market. Guys, I've been telling you multiple times on Friday updates, but also in my Data Dash Telegram group for those who are subscribed to the newsletter, that these months in crypto gonna be quite boring and then we're gonna have a better play. Right now, we are bouncing quite strongly, and I believe that the closure with the significant volume, almost 4% on the day, gonna actually give us a nice and prolonged bounce for the Apple lovers. I believe here we are starting to curl up. The volatility bands are expanding. This is absolutely okay if you're still not in Apple. For those who doesn't remember the reasoning for entry, in short, Apple has actually taken a lot of efforts in acquiring the AI companies, but didn't really make any announcement. And with that said, we are holding quite well this level. We are currently on the weekly. We can see that on the money flow index, the huge liquidity starts to flow in. I believe we're gonna test those poor highs. It is very, very unlikely that those equal highs at around $197 would actually be left untapped, simply from the liquidity perspective. Forget about fundamentals, forget about Magnificent Seven. It's just the pure short trades that have to be kicked out. They have to hit their stop losses. If Apple actually would like to reverse down, it would first like to play the range bound and go down without any passenger in that train, so market makers can actually rebuild their positions. That is a very typical external range trade. If you are not in Apple scaling wire cash secured puts, that's absolutely okay. The trade still gives an opportunity to enter right now. As of 175 daily open, you can enter at pre-market, and that would be your entry point. Your stop loss would be just prior the lows, and your take profit, as I said, would be the swipe of the highs of those range at around 198 level. So with that said, even if you're not yet in the trade as I am, your risk to reward is still 2.5 to 1. Please don't oversize, because you are not allowed to lose more than 2% on any particular trade. So despite it as Apple, we are still treating it as the trade and not as the value investment. Let's look right now on the BTC chart. First of all, we are in a range bound in the middle of the range. I'm not really excited at all to take any trade with such a high degree of uncertainty. We are probably, as I said 3 weeks ago, guys, everything stays as the game plan valid. We might swipe the previous all-time high, and we might swipe as well the range lows. What I particularly do not like here, when we're going to be looking on the futures data on Coin Analyze, you see, for example, this huge spikes in open interest as soon as we are breaking above 70,000. Obviously, those late longs are jumping in, and it's more obvious to me that every move to all-time high is getting those FOMO longs, which are actually puking due to the increasing funding, which is not sustainable. We're probably getting to 70-80% interest rate per year. And then the blue line and spot starts to sell. So this move is absolutely not confirmed by the spot buyers. The spot buyers prefer to actually distribute above the level of 70. And then what happens, as you can see here on the chart previously, we're just having those $2,000 puke candles in a matter of 15 minutes. And it has been the case multiple times here and here and here. So this is not a sustained move I would be enjoying actually watching. So for me, first of all, as soon as we fully accept above the range highs here and reclaim it, there is no long. The second thing, when speaking about alts, I really do not like how Bitcoin dominance has been creeping up. It is very, very likely that this level sooner or later would be taking. And starting from 55% on BTC.D, the alts can bleed even further. Why I think so? Well, because if we look on the ETH to BTC chart, the picture is also not most promising. On the one hand side, we have printed the market structure break. So this high is above this high. So normally what I would be looking for is for that order block to be holding. On the other hand side, I would say that if you go on the weekly chart, this chart does not really look particularly bullish, especially once we start swiping one low after another. But also, if I just zoom out and look at 2021, 2022 levels, there is so much more room to go lower, especially on the monthly, where we had a lot of volume being transacted at these and these levels of 3 and 4% respectively. So to sum up, I am not really yet excited to jump in any of the particular alt trades. With the dominance creeping up and alts being quite a risky place, I believe we still have a few weeks of consolidation into halving, so I would not rush into much more alt trades for now. If you, of course, have allocated to the fundamental coins like Phil and Aave, I would not yet cut, especially since that was the spot trade. But don't also get overexcited on leverage and don't yet add into your positions. What I believe here is much more interesting, especially if you're bullish on Bitcoin and you believe that it has the potentiality of a prolonged rally into halving. I would be much more curious to look into the miners here. On one hand side, you have the WGMI or WAGMI Valkyrie Bitcoin Miners ETF if you don't want to do the due diligence and allocate to any particular stock. My favorite one is the Clean Spark, and you can see here how the periods of price extension have been confirmed by increasing volume. On the other hand side, how all the price declines have seen the lower volume. So that means, in my opinion, a Clean Spark is actually forming its bottoming formation, and with the Bitcoin ranging somewhere relatively around this current range high, Clean Spark has quite a nice probability to swipe those levels of 26 or 27. I also would, among all, quite like the company fundamentals. You can see the Bitcoin production, the mining hash rate, the revenues, the net income, company is already net income positive, and so on and so forth, have been steadily growing in the quarter by quarter in the last year. On the other hand side, I can see that the short interest have been piling in, and what I normally like to do when we have those kind of situation, I like to go into the chart and look more into details on the divergences. If sellers are getting exhausted, obviously those bottom shorters and increasing short interest is an indication for me of the trade asymmetry, and I like to be on the contrarian side of the trade. What I'm looking for is those hidden divergences when price have been going up, but the RSI is continuously go down. It looks for me that the sellers are getting more and more exhausted. So we see those signs of divergences here, 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 and then price normally bounces. So when it comes to numbers, I would be looking at something like that. You can enter here with a very tight invalidation below the previous low, and you can target the recent highs from 2 weeks ago. In my opinion, it is quite a strong trade, much better than MicroStrategy or Bitcoin itself. You can be exposed to 56% upside with just 7 or 8% downside. So the risk reward ratio here is nearly 7 to 1. And the clean spark itself is, in my opinion, as mentioned, fundamentally my favorite miner. Another one to look at would be Marathon Digital Holding. Let's have a quick look at Mara. A Marathon would provide even better risk reward in my opinion, but Marathon has the certain danger with the way they mine the BTC. I can cover it a little bit more into details on Telegram because that requires a complex formulas for calculation. It will be quite hard to provide it on the video, or at least the video then would take 20 minutes. But here in Marathon, the risk to reward ratio, if you get invalidated below the previous lows, or you can give yourself a couple more percents for the stop loss volatility. It doesn't matter because your risk reward ratio is either 7 to 1 or it's 10 or 15 to 1. I would say give yourself a tiny bit of room to dollar cost average because it is not certain that Bitcoin has bottomed here. So obviously miners are quite volatile. I would actually DCA all the way into the yellow boxes, maybe yeah, like these two zones of DCA, and the stop loss around $15. If you actually want to sleep well and not to worry that much about what the Fed is doing and how the interest rate cuts gonna affect any particular price action, $1 up and $1 down should not be your worry if you are invested, in my opinion, in Warner Brothers, because with a $5 billion free cash flow and price to earning ratio of just 4, this company, in my opinion, has an amazing 2.5x upside probability. What is particularly great about that stock, in my opinion, that despite this is a very functional business with good prospects of growth, we are still very close to our point of invalidation. For example, if you're gonna enter the trade at around $8.5, where Warner Brothers is actually trading right now, then you do not have to exercise the large stop loss. Your stop loss can be as low as, I would say, $7.99, just a little bit below the 8, because a lot of beats can come in there. And I would be comfortably holding that stock. Great thing about trading is that you don't have to be right all the time, and you also don't have to be right the majority of time. If your risk reward is 3 to 1 or even higher, it is absolutely fine to be right just 40% of time if your invalidation points are tight and if you keep not adding to the losing trade. If things turn around against you, that is absolutely fine to take a loss and to add back later. Unfortunately, our brain is wired in a way that once the trade is going against us, we keep adding to the losing trade, waiting for it to go back into the break even and to see the green number on the screen. And once we see the green number, we are taking profit. That's unfortunately how the majority of younger traders start. What we have to do instead, we keep our runners run and we add and we keep adding to the winning trade, making sure that our stop loss is turning into the trailing stop loss. I also got multiple requests to check on our silver trades. In my opinion, there is absolutely nothing to worry about, apart of the fact that some people might not get their positions filled, because as you can see on the silver chart, silver has already broken above $29, and in my opinion, due to such an extended move, the $32 is actually our most potential next step. This is the point I will be looking for taking the profits and adding on the swipe into 25 or 26 if given. When it comes to the junior miners, it is actually very improbable that they would see a severe dip So I see most of them are already fighting with 800-day moving average on the daily. And once we accept above, like Aftermath or Silver X, in my opinion, still provides the good entry here at 200-day moving average. I would still say that's the huge buy. There is nothing to worry about, and those price levels would not be seen in a week or two from here. When it comes to the ETFs, I know some people had troubles scaling into them if they are trading from Europe. You can always try to get assigned selling cash secured put at the shortest expiration date, and then you will be forced to buy 100 stocks. That's like a little trick that the European users can do. When it comes to our cannabis trades, if you remember, for those who follows my trade alerts, we've been exiting on the 5th of April at around 220, 225 prices. Right now, SNDL has bounced all the way down to 195 and so far holds that level that I've been indicating in the very beginning. So I nevertheless see a certain potential weakness in SPY. So I'll post an alert once I'm gonna be adding a DCA here, but for now I want to see that this level is confirmed and we are accepting higher. On the other hand side, on poor report, Tilray had a nice dump all the way into 190, and if you remember, I've been mentioning that I will be happy to DCA in that area between 160 and $2. So some of the smaller bids already got hit, and I would like to update you next Friday, guys, if we're gonna increase our position on the way to 2 digits. If those who watched our video 2 weeks ago, you remember I had made some significant profits, but I took them already on the 5th of April. This well coincides with the beginning of today's update and with my slightly cautious stance on the market. Guys, I'd like to cover so much more. I couldn't have time for all of those. We covered briefly how I'm analyzing the trade based on the open interest alignment with price over coin analyze. For the next video, I'd like to show how I'm looking at liquidation heat map levels, how I am analyzing the order flow. And with that said, I wish you all the great end of the week and stay tuned.